Hello, my name is Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. Kansas City wheat. It's been a few weeks since my last commentary. This has been due to my participating in a number of conferences on technical analysis in the UK and abroad. But it's given me the opportunity to take a fresh look at the market here. The key patterns here for many months now have been the late March to late June diamond pattern type and the extension of its lower uptrend, highlighted in bright green on my daily chart, and the larger, big inverted roof pattern, sometimes called a half diamond, which is highlighted in purple on my daily chart. Now, prices managed to reach the primary target of the first diamond pattern type but failed to make it to the hard to reach secondary target. In early August, the market punched down through the purple uptrend of the inverted roof pattern and have headed lower ever since. So where does that leave us now? I said when the move lower started, and I quote, a primary target X2 for the inverted roof stroke half diamond pattern will be down in the 733 zone, with a secondary harder to reach target X3 down at 646. This is only the first few days of this move lower, so it could still be a false break, but those are the potentials for such a pattern as this inverted roof pattern. End of quote. The move lower now obviously is not a false break, as the primary target X2 in the 733 zone has been achieved in late August, and the move down these past 2 weeks has broken down through some interesting supports that are now resistances, specifically the big 50% absolute Fibonacci line at 697 and the 50% Fibonacci line of the 2011 to 2019 move at 691. We are seeing the market edge ever closer towards target X3, but it is still at the moment a cautious move lower. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat had been somewhat easier to read in recent times with respect to what was going on and what the opportunities might be. In late February, and especially at the start of April, the market constructed a large bear channel that morphed into what we see highlighted in dark blue on my daily chart, a descending expanding wedge pattern, currently 823 to off the bottom of my daily chart. This originated from December last year but really became evident from February this year. The upper trend line has been previously reinforced, well, sort of, by the declining medium moving average, currently 817, which combined together to help cap the market in very early April, then mid-April, mid-May and mid to late June. However, in mid-July, the attempts higher resulted in a clear break above the upper trend line and also the important declining long moving average, currently 845. Prices climbed rapidly up to the 50% Fibonacci line and significant August 2020 to May 2022 move at 955, where the rally petered out and turned back down. It is this turn back down that has captured my attention, as the market has, since late July till mid-September, formed a descending scallop pattern, a clear one. Not only that, but since mid-September we have seen the market form the ski bump of the descending scallop pattern, the lip, and since the start of October prices have started on their journey lower to potential targets for such a pattern below. Thus, a primary target X for such a pattern would be in the 708 zone, with a secondary harder to reach target X1 in the 689 zone. To be honest, apart from the May 2021 low at 676, we don't seem to have much support below right now. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final important bit.